The Federal Reserve Bank has recently become the center of attention, with everything from money printer memes to the future of capitalism as we know on the line. It is clear that the Fed has enormous power. However, the majority of individuals either don't know very much about it, or worse, they believe they know a lot about it when they actually don't. However, since the Federal Reserve Bank is a bank, it is okay. The only way to truly grasp how it operates is to follow the money and respond to a straightforward inquiry. Is the Reserve Bank profitable? Hello, and welcome to Financial Fluence. In this video, we'll talk about whether the Federal Reserve Bank is profitable or not. Because I despise YouTube videos that drag out a question to increase watch time, the simple answer is yes. It is massively profitable and is the world's most profitable company, surpassing Saudi Aramco. But before you go away, for starters, I need that average watch time too. But more importantly, learning how the Federal Reserve Bank uses money to make enormous profits will educate you a lot about how the seemingly mythological organization truly functions on a daily basis. Therefore, unlike any other bank or firm for that matter, the Reserve Bank does not have as its primary duty to produce profits for its owners. Instead, the Reserve Bank's two main objectives are to limit inflation and preserve the value of the currency they represent, which is their first and most essential goal. Maintaining a healthy level of employment and economic growth is the second objective, but oddly enough, this cannot be done at the price of the first objective. The Reserve Bank would consider a year in which the US economy expanded by 50%, but prices increased by 50% to be a failure, even though this is obviously an extreme case. However, this does not imply that the US Federal Reserve is a single company and does not even imply that it has shareholders. In reality, the 12 institutions that make up the US Federal Reserve Bank are dispersed around the country. It was designed in this way because in 1913, the majority of banking transactions included paper notes and records, making it essential for each region to have a central bank that is close by so they can do business quickly when necessary. It was also politically popular to have a number of central banks, each of which would be sympathetic to the demands and wants of its own particular economic sector. Who are the stockholders now, by the way? They were the standard banks after all. You must own stock in the Federal Reserve Bank in order to open a bank in the United States that will lend money and accept deposits. Each individual bank must continue to keep 6% of the total number of shares it has acquired from shareholders. Although it may seem strange, there is a purpose for this regulation. But before we continue, I'll give you time to subscribe, like, and switch on the notification bell to be notified whenever a new video is uploaded. There are essentially three ways for banks to raise capital. They can accept deposits, borrow money, or sell stock. The Federal Reserve has direct power over the first two alternatives via changes in interest rates. But selling shares is unaffected by these changes since shares are not an asset that bears interest. On Apple shares, market returns are paid out instead of the promised 5% interest rate, whatever they may be, positive, bad, or in the opposite direction. By requiring banks to possess shares equal to their contributions, the Reserve Bank ensures that participants have skin in the interest game. These shares always pay out 6% of their value, which is unusual for two reasons. First, it has a great guaranteed return, especially compared to similar investments that pay less than 1%. Many have complained that the American taxpayer is subsidizing major banks, which is reasonable. This is interesting since it will be paid out regardless of whether the federal government generates a profit or not, unlike typical dividends. These shares in the Fed blur the line between corporate stocks and fixed interest bonds. This doesn't explain how the Fed makes money. Unfortunately, money printer memes are misleading. The Fed doesn't create money for whatever they want. They invest their money in government bonds and mortgage securities. They can't buy as much with this increased cash. The US Treasury issued trillions of dollars in bonds to finance 2020 stimulus expenditure. The Fed couldn't immediately buy these bonds. Instead, private parties like banks or simple mortals like you and I buy them. Banks favor government bonds because they may use them as a reserve while receiving interest. Not much, but it's better than 0% in cash reserves. The Reserve Bank is ready to step in if banks or the government need a lot of cash. In 2020, the Fed bought trillions of dollars in bonds from banks so they could buy more from the Treasury without affecting the price. 1% of billions of dollars is a lot of money, especially when these bonds are paid for with free money. Assuming a 1% return, the Fed's $4.8 trillion in US bonds would yield $48 billion each year. When you consider that the Fed holds $3 trillion in private sector securities like mortgage bonds, this annual profit number explodes to far over $80 billion annually. Everything we've looked at so far is an open market business. The Fed buys assets off of the open market. Closed market operations are a less noticed revenue source. The Fed is a bank for banks, offering deposits, loans, transfers, and cash distribution. Like any other bank, the Fed charges fees for all of these services, and you can obtain a breakdown of these fees on their website, not that they would matter to you individually. Nevertheless, these services bring in billions of dollars a year. The central bank's open and closed market activities netted over $90 billion in 2020, making it the world's most profitable organization. How is this fair? Why is the Reserve Bank permitted to create money from nothing to acquire debts and make large profits on the returns? If the government creates all the money and then charges interest on it, won't we all be in debt to it? Well, not really. Tinfoil hats aside, the Feds utilize this money for security, personnel compensation, and building maintenance. It will then pay its financial expenses, such as interest paid to banks with Fed deposits, and the annual 6% dividend. What's left is transferred to the Treasury. In 2020, the Fed returned $88 billion. This makes the Fed a cash flow regulator between households, the government, and financial institutions. It's not as thrilling as global dominant stories, but that's all they are. And that's all we have. I hope you enjoyed this video. If you enjoy similar stuff, check out my other videos. And if you like it, hit the like button, subscribe to the channel, and turn on the notification bell. And I'll see you in the next video.